What is a good price to cash flow ratio? Passive income is the goal of every long-term real estate investor, and that goal begins with calculating cash flow. Understanding how good cash flow is generated can help you select the best rental properties and also unlock hidden opportunities that other investors may miss. And that's what we're going to talk about here today. You ready? Let's go. So for many investors, you either invest in real estate for cash flow or you don't invest at all. Why such a strong statement? Well, that's because cash flow is such a strong force when it comes to income properties. So strong, in fact, that cash flow is essentially the main form of profit that you experience right away and consistently over time. The type of income that can render you financially independent. This makes investors wonder just how much cash flow is good for rental property. Well, let's take a look. Oh, and by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done. And then how to earn $5,000 a month flipping contracts and properties working as little as 1 hour a day. And you can access it at mattsfreetraining.com. But before we dive into what makes for a good cash flow ratio, it makes sense to define what cash flow actually is so, we're on the same page. In real estate, cash flow is what you get when you subtract a property's expenses and debts from the income the property produces. A property can have positive cash flow, where there is more income than expenses and financing costs, or negative cash flow, where the expenses and financing costs exceed the income. And in this scenario, the landlord loses money each month. Most real estate investors aim at owning rental property with positive cash flow, of course. The more cash flow a property has, the better the return and the more income the real estate investor earns. Having higher cash flow also provides the landlord with a safety net for when unexpected expenses arise, like a burst pipe or roof replacement or a new AC or furnace. The more cash flow you have, the easier business and overall life are. Now, how is calculated? Calculating a rental property's cash flow is a relatively simple process. 1, determine the gross income from the property, deduct all expenses relating to the property, subtract any debt service relating to the property, and what you're left with is the property's cash flow. The gross rental income of a property is the total income from all sources before any expenses or mortgage payments are made. And some properties, like a single-family rental, will only have one source of income, the rental income. But commercial properties may have additional income streams like on-site laundry or parking fees or vending machines or storage fees. Expenses relating to a property can differ greatly by property type as well. A single-family residential property may have just taxes and insurance, while with a commercial property, the owner may have all of those plus maintenance fees, service fees, and utility fees. Subtracting the property expenses from the gross income provides you with the property's net operating income, or the NOI. Now, if there is debt service, this can be subtracted after the expenses to provide the property's cash flow after financing. And this is the true cash flow number. When looking at a property to purchase, there are times when a property's expenses aren't available up front. And that can be a problem to determine whether or not a property is worth your time even analyzing. No problem though. I've got a quick way to analyze any property to determine whether it is a worthwhile investment deserving of your time. And if you'd like to know what that is, let me know by smashing the like button. And if you take your real estate investing seriously, make sure you subscribe to the channel too, because that's what we talk about here each and every week. Creating passive income from real estate so you can retire early and enjoy the good life. So if you don't have all of the numbers from a property that you need to calculate its cash flow, as a shortcut, you can use what's called the 1% rule. The 1% rule, it's a formula used in real estate to determine whether a property is likely to have positive cash flow. Now, the rule states that the property's monthly rental rate should be, at a minimum, 1% of the purchase price. So if a property is for sale for $200,000, it should produce a rental income of $2,000 a month or more if it's going to produce a positive cash flow. If it only has a rental income of $1,500, it wouldn't satisfy the rule because $1,500 is less than 1% of $200,000, and therefore it's unlikely to produce a positive cash flow. The higher the rental income in relation to the purchase price, typically the greater the cash flow you can expect from that property. Now, keep in mind, the 1% rule is a general rule of thumb. There are certain real estate markets where this rule simply just doesn't apply. For example, if the rental property is in a state with high property taxes, or an area that requires additional insurance for floods or hurricanes, or has deferred maintenance that will require additional ongoing expenses, the 1% rule might not work. But for most markets, you're good to go with it. Just know this, the rule is not the final cash flow analysis. It's simply a quick tool to use to see if you want to pursue a property further, if you want to go deeper into the detailed math. So, exactly how much cash flow is good for rental property? Well, there's not a clear-cut universal answer to that question. Like many things in investment property analysis, the answer is it depends. The one thing that is for sure, however, is that positive cash flow properties are what real estate investors should aim for. The more positive cash flow an investment property has, the better, in my opinion. From there, along with some variable influences, we can determine how much cash flow is good for rental property. So to do that, there are 4 things to consider. 1, the type of property. The type of rental property is vital when figuring out how much cash flow is good. Investment properties with multiple units are expected to have higher cash flows than single unit properties. As a result, multifamily properties typically have higher cash flow than single family units. So the overall price of an investment property also factors into how much cash flow is good for a rental. Properties that are more expensive and typically are of a higher risk would warrant more income than less expensive real estate investments. Properties with newer or more elaborate renovations and amenities also would warrant a higher rental income, of which most of the time results in a higher cash flow. Then there's the location. The most significant aspect of real estate market analysis is location. We hear it all the time, location, location, location. Well, the location of an investment property is vital when discussing cash flow property analysis as well. A lot of the primary expenses like interest rates, property taxes, and association fees are strongly influenced by the location of the property that's determined geographically. The amount of rental income, it's also heavily tied to the areas, like the job market most notably. Other non-real estate market factors impact an area's measure of good cash flow too. Influences from legislation and the economy can significantly impact cash flow in an area. And then there's the investment strategy. The investment strategy of a rental property also impacts cash flow. For example, a short-term rental investing strategy tends to yield higher cash flow than traditional landlord. Or using the property for student housing or assisted living will also produce much higher cash flows. And then you got to consider the financing. The financing of an investment property will play a significant role in a property's cash flow analysis. For example, the higher the interest rate on your loan, that results in a higher payment, and that directly gobbles up your cash flow really fast. So good financing is very important. The final answer, to determine how much cash flow is good for rental property, we need to express cash flow as a percentage, not as a value or a dollar amount. So there are 2 ways to turn cash flow into a percentage. Both ways are fairly similar though. The first way, the cash-on-cash return calculation. So cash-on-cash return is a result of this equation here. The annual rental income less the expenses and the costs and the debt service divided by the total cash investment, and then you multiply that by 100%. And that will give you your cash-on-cash return percentage. So a respectable positive cash flow investment property in terms of a cash-on-cash return is a property that generates something in the ballpark of 8% or more. Second, the cash zone formula. So cash zone equals gross annual rental income divided by the property price multiplied by 100%. A good cash flow in terms of cash zone, you might have also heard it as the gross rent multiplier, is anything that is between 8 to 10% or more. If you're in the market for income properties that meet these criteria, I've got some free information for you. Download an investor's package at cashflowsavvy.com. And if you like what you see, you'll have the opportunity to pick a time for us to hop on the phone and strategize your passive income retirement. And it all starts at cashflowsavvy.com. That's it for now. Thanks for watching. I'll see you next time. Take care.